Hey there, welcome back to another exciting episode. Today, we're diving deep into Chapter 12 of The Psychology of Money, which is aptly named Surprise. We'll talk about why the biggest financial events are always a surprise, how our brains are wired against surprises, and why a little bit of humility can go a long way when it comes to your finances. If you're ready to uncover some hard truths and gain valuable insights, let's get started. Part 1. Why the past doesn't predict the future. Most financial advice is rooted in history. Experts analyze past trends, make educated guesses, and project them into the future, helping us make informed financial decisions. However, as Morgan Housel points out in this chapter, history is a misleading guide because the most important events are one-time surprises. We only recognize their importance in hindsight. The Great Depression, the 2008 housing crash, the COVID-19 pandemic, the invention of the internet, Bitcoin, AI, inflation spikes, these are all examples of tail events that shook the world and changed everything. But they weren't predicted by the mainstream. The most important events in history are the tail events, says Morgan Housel. Think back to the days before smartphones. Did anyone predict the meteoric rise of Apple, Google, Amazon, or Facebook? These companies didn't fit into any existing industry. Their success wasn't foreshadowed by past performance or expert predictions. They were surprises. Yet they have dramatically reshaped our economy, our culture, and our daily lives. Tail events aren't just about technology. They span various aspects of finance. Take, for instance, Warren Buffett predicting the downfall of the U.S. housing market after the year 2000. Despite being hailed as the Oracle of Omaha, he didn't anticipate the 2008 financial crisis. In fact, he invested heavily in the very banks that eventually needed bailouts. He was blindsided by the crisis, just like many others. The most important events in history are the ones that people aren't thinking about, says Morgan Housel. Financial models and experts often focus on averages and past trends. They assume the future will resemble the past. But as we've seen, this assumption can lead to catastrophic mistakes. For example, imagine someone who consistently earns high returns in the stock market. They might feel invincible and decide to invest even more aggressively, believing their winning streak will continue. But one unexpected market downturn could wipe out years of gains, causing them to lose faith in investing altogether. The point here is clear. Focusing solely on averages and historical data can paint a distorted picture of the future. As Morgan Housel urges us, we must look beyond what has happened and consider what might happen. Part 2. The world is driven by tail events. In statistics, a tail event refers to an outlier, a rare and extreme occurrence that lies at the extremes of a probability distribution. Finance is no stranger to tail events. In fact, it's driven by them. Crashes, booms, wars, technological disruptions, and natural disasters all fall under this category. Understanding tail events is crucial for making sound financial decisions. Take, for instance, investing. Imagine two investors, one who only invests in safe, stable assets like government bonds, and another who ventures into riskier investments like growth stocks and emerging market funds. The first investor might boast a consistent but modest return over the years, while the second investor experiences wild swings in their portfolio value. On average, the second investor might still outperform the first, but their journey is far from smooth. Now, enter a black swan event, an unexpected and highly impactful outlier, like the dot-com bubble burst. This event would decimate the second investor's portfolio, regardless of their average long-term returns. Safe investments like government bonds would remain relatively unscathed. This illustrates the power of tail events. Even if a risky investment has outperformed historically, a single extreme event can wipe out all those gains and more. It can take years, even decades, for them to recover. Consider the impact of the COVID-19 pandemic on industries. Airlines, hospitality, and retail were hit hard. Entire business models that seemed robust and resilient suddenly faced bankruptcy. Conversely, technology companies boomed. Video conferencing, e-commerce, and streaming services saw unprecedented growth. These dramatic shifts weren't predicted by traditional financial models. They were surprises that reshaped the economic landscape. Part 3. Our brains hate surprises. When it comes to understanding probabilities, our brains aren't playing fair. We're naturally wired to seek patterns and predict outcomes. After all, it's a survival mechanism. But this instinct can lead us to make irrational financial decisions. For example, imagine flipping a coin. If it lands on heads 5 times in a row, you might start thinking it's due for tails. Despite understanding that each flip is still a viable option, your brain craves a pattern. It wants to believe that if A happens, then B will follow. This cognitive bias colors our perception of financial risks. We tend to overestimate our ability to predict future outcomes based on past performance. We trust financial models that align with our beliefs, even when they're statistically unsound. Take, for instance, real estate. After witnessing a consistent upward trend in property values, we might assume that prices will continue to rise. However, this assumption ignores the possibility of a sudden market shift. Similarly, our brain's pattern-seeking ability can also lead to a false sense of confidence. For instance, after successfully investing in the stock market for a few years, we might feel like seasoned pros. This inflated confidence can push us to take unnecessary risks or make impulsive investment decisions. Furthermore, our brains have a tendency to simplify complex information. We categorize the world into neat boxes, making it easier to navigate. But when it comes to finance, this simplification can be misleading. We might assume that certain investments are risk-free because they've always performed well in the past. Or we might disregard alternative investments because they don't fit into our existing financial categories. This cognitive bias prevents us from exploring new investment opportunities or considering alternative strategies. It keeps us confined within the boundaries of our current financial paradigms. Part 4. What surprises teach us about risk? So how should we define risk in the face of these unpredictable tail events? Morgan Housel offers a compelling perspective. Risk isn't a percentage. It's not a volatility index. It's the potential for something unexpected to destroy your plan. Take, for example, losing your job during a recession. This event isn't captured in a neat mathematical formula. It's a real-life scenario with devastating consequences. Similarly, a market crash the year you retire, a health crisis that wipes your savings, or a tech disruption that kills your industry. These are all examples of actual risks that can derail your financial plans. We need to acknowledge the limitations of traditional risk assessment models. Yes, they provide valuable insights, but they cannot account for the unexpected. To truly understand risk, we must consider the possibility of extreme events, those that lie outside the realm of historical data or statistical models. Only then can we develop a comprehensive and realistic view of the challenges that might lie ahead. Part 5. How to prepare for the unknown. So how do we navigate this unpredictable financial landscape? How do we prepare for the unknown? Morgan Housel offers several practical tips. First, expect surprises. Don't walk into the world expecting things to go according to plan. Instead, be mentally prepared for the unexpected. Embrace a mindset that anticipates surprises rather than being blindsided by them. Second, stay flexible. Rigidity is the enemy of adaptability. Be open to adjusting your financial plan as circumstances change. Don't be afraid to pivot if a surprise event rocks your boat. Flexibility will allow you to steer through turbulent waters without capsizing. Third, keep a margin of safety. This is a classic principle from insurance. Just as insurance policies have a margin to cover unexpected events, you should build a similar buffer into your financial plans. Whether it's an emergency fund or a contingency plan, Having a margin of safety provides peace of mind and the ability to weather the storm. Fourth, avoid overconfidence. This is a subtle but powerful tip. Don't let past successes or financial models inflate your confidence to the point of arrogance. Always remember that surprises can happen despite past performance or expert opinions. Stay grounded, question your assumptions, and don't fall into the trap of thinking you can't lose. Part 6. Why Humility is a Superpower. Let's bring this chapter to a thought-provoking close. Morgan Housel doesn't leave us with a note of defeatism. Rather, he underscores the idea that humility is a superpower. He highlights that even the world's best economists, investors, and entrepreneurs didn't see the big events coming. Surprises, as he says, are the norm, not the exception. By acknowledging our fallibility, we set ourselves up for better financial outcomes. It's in our vulnerability that we find the strength to adapt, to learn, and ultimately to thrive. So here's to embracing humility, to recognizing our shared humanity in the face of the unknown. May it serve as our guide as we navigate the complexities of finance and the surprises life has in store. That's a wrap, folks. We hope you found this exploration of Chapter 12 of The Psychology of Money insightful and thought-provoking. Remember, in the unpredictable journey of finance, preparation meets opportunity. If you enjoyed this episode, please give us a thumbs up and subscribe for more. Until next time, stay curious and keep those financial surprises in check. Thanks for tuning in.